Let's be honest. A $500,000 house used to sound like luxury. Now, in many cities, it's just average. But here's the real question. Who will actually be able to afford one in 2026? Not dream about it, not scroll Zillow at night, not say one day. Actually qualify for it. Because when you run the numbers, the math gets brutal. Today, we're going to break it down. Income required, interest rates, down payment realities, debt-to-income ratios, credit score impact, regional cost differences, and what inflation is quietly doing in the background. By the end of this video, you'll know exactly where you stand, and you may not like the answer. When people say, "I can afford a $500,000 house," what do they usually mean? They mean, "I can make the monthly payment." That's not the same thing as affordability. Real affordability means you qualify for the mortgage, you can handle taxes, you can handle insurance, you can handle maintenance, you can survive unexpected repairs, you can still invest, you can still build wealth. If buying the house makes you house poor, you didn't afford it. You survived it. And survival is not financial freedom. Let's run a realistic scenario for 2026. Assume house price $500,000, down payment 20%, $100,000, loan amount $400,000. Now let's assume interest rates stay around 6.5% to 7%. At 7% on a $400,000 loan for 30 years, your principal and interest payment alone is around $2,600 per month. Now add property taxes, varies by state, but let's estimate $500 to $800 per month average. Home insurance, $150 to $250 per month. Maintenance reserve, at least $400 to $600 per month, 1% rule annually. Now your real monthly cost becomes $3,800 to $4,200 per month. That's nearly $50,000 per year in housing costs alone. And we haven't talked about utilities, or HOA, or renovations. This is the baseline. Most lenders use a debt-to-income ratio of 28% to 36%. Let's use 30% for simplicity. If your housing costs are $4,000 per month, that's $48,000 per year in housing costs. To keep housing at 30% of your gross income, you need to make $160,000 per year gross before taxes. Now remember, that's assuming no other debt. If you have car payments, student loans, credit card debt, your required income goes even higher. So realistically, to comfortably afford a $500,000 house in 2026, you likely need to earn between $160,000 to $200,000 per year household income. Let that sink in. Most people don't have $100,000 sitting in cash. So let's say you put 5% down. That's $25,000. Now your loan becomes $475,000. Your monthly payment jumps significantly. And now you add private mortgage insurance, PMI, another $200 to $400 per month. Now your housing cost could exceed $4,500 to $5,000 per month, which pushes required income toward $180,000 to $220,000 per year. And that's just to qualify, not to feel comfortable. Here's something most people ignore. A 2% difference in interest rate changes everything. At 3% interest, like we saw a few years ago, a $400,000 loan costs around $1,700 per month. At 7%, $2,600 per month. That's nearly $1,000 difference per month. Same house, same price, completely different affordability. So unless rates collapse dramatically, 2026 buyers are facing a different reality than 2020 buyers, and that reality is expensive. Inflation doesn't just affect groceries. It affects construction materials, labor costs, insurance premiums, property taxes, and home repairs. Even if home prices stabilize, carrying costs keep rising. So even owning becomes more expensive over time. The purchase is just the beginning. Let's answer the question directly. In 2026, A $500,000 home will realistically be affordable for dual-income households earning $170,000 plus, high-earning professionals, business owners, investors with strong cash flow, people relocating from higher-cost markets, and buyers with significant equity from previous homes. It will not be easy for single average earners, middle-income households with debt, buyers with low credit scores, and people without savings. That's not pessimism. That's math. Your credit score changes everything. At 760 plus credit score, you get the best rates. At 680 to 700, higher rates. At 620 to 650, much higher rates. Even a 1% higher rate can cost tens of thousands over 30 years. Credit discipline now determines housing power later. In some states, $500,000 buys a luxury property. In others, it buys a modest starter home. Taxes in Texas differ from Florida. Insurance in California differs from Ohio. HOA fees vary wildly, so the income requirement is location dependent, but the broader trend is clear. Affordability is tightening, not expanding. There's something else happening. People feel pressure to buy before it's too late, but buying under pressure is dangerous because when you stretch too far, you become house poor. And being house poor means no investments, no margin, no flexibility, no risk-taking, no freedom. A house should increase stability, not remove it. Instead of asking, how can I qualify? Ask, how can I strengthen my position? Focus on increasing income, eliminating debt, building credit, growing savings, investing consistently. Then buy when the house doesn't own you. Unless rates drop significantly, unless incomes rise dramatically, unless prices correct heavily, a $500,000 house in 2026 will remain affordable to a smaller percentage of the population. The middle-class squeeze is real. Housing is becoming a wealth filter, not just a milestone. So who will actually be able to afford a $500,000 home in 2026? High earners, strategic savers, disciplined borrowers, and people who prepared years in advance. The brutal truth? Affordability is no longer about desire, it's about structure. If you build structure, ownership is possible. If you don't, it becomes stressful. This video is for educational and informational purposes only. It is not financial advice. I am not a financial advisor. Always consult a qualified professional before making major financial decisions. Now I want to hear from you. Do you think $500,000 homes will become more affordable by 2026 or even less? Comment below. And if you want more honest breakdowns about money, markets, and financial strategy, subscribe. We talk about money without hype, just math. See you in the next one.